Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. And if you're looking for undervalued investment opportunities, click subscribe to the channel, join our community. Let's ride this, whatever's undervalued at that time, let's ride this thing higher together. So I wanted to make a couple of points. I'm also looking through the comment section, so I'm going to answer more questions because I think it's very important that I answer a lot of your guys' questions. Maybe not all of them. One thing I wanted to make sure, if you guys try linking certain things in the comment section, I think it goes under a different area for, quote, held for review. And I don't see those. I hardly ever go in that held for review because there's a lot of garbage in there too. So if you don't see a comment that you posted, it's not me like monitoring this stuff. It's YouTube, where if you link certain things, it just automatically, it almost hides it from me. And it hides it from everyone else as well. It goes under a held for review, and I don't really go in there because there's so many things in there that's just kind of garbage. So I may miss some of your posts if you're linking things. That's one thing I wanted to get in. Now, another thing that I want to talk about is you have to understand what I'm teaching on the channel, because I could hand you a whole bunch of companies. I could literally hand you 100 baggers. And if you don't know the basic teachings on this channel, you could literally put the stocks in your portfolio, hold them for 100, 200, 300% gain, and then sell out. Even though it could be a 100 bagger return. A 100 bagger is 100 times your money. That is 10,000%. No, is that right? Yeah, 100 bagger is 10,000. 1,000 is 100,000. So you have to understand this stuff in order to get the returns. And I'm going to make this comment. If you do zero work, if you don't learn any of this stuff, if you don't learn how to value, it's basically being able to value things. If you don't know what the value is, if you don't know when something's undervalued or overvalued, that money is not going to go into your account. The money goes to those that are well-deserving and patient and well I'm not going to say well-educated, but it's more of trained. You're going from someone who doesn't know anything to a trained professional. And it doesn't, you got to take the emotion out, you got to take the stories out, and you got to be laser focused. And you can evaluate companies however which way you want. You can do the fundamentals. You can look at some of this stuff. And looking at fundamentals is vastly different in some companies versus other companies. A producer, you can kind of get numbers and cash flows and all that stuff. In a developer, you're not going to get cash flows. They don't have any. They're not producing yet. And then in an explorer, you might be looking at, like, are these guys spending money prudently? Are they just willy-nilly spending it on, like, their health insurance? I mean, some companies do that. And then you know what you do? You throw those in the garbage. So I with the developers and the explorers, I rely very heavily on technical analysis because you don't really have much to go off of. So it's not like I can be like, yeah, we got this company, it's awesome. They're going to develop a mine and spend a bunch of money. Do they have the money that they have? Maybe they can raise it. I'm not exactly sure on all of them because they may use different methods for raising money. They may dilute the shareholders, which is not good. But if you go to a company that is very shareholder friendly, you've got management that holds big stakes in their companies, they're not going to dilute themselves too much. At least that's my opinion. And if they own 10% or more, that's a pretty good stake in the company. So I'm gonna go through some other questions. I brought up the point of low risk, high return commodities and stocks that are under their cost curve. But some people are having a difficult time spotting what low risk, high return commodities and stocks are. And at Homer, I know who you are. I've read a lot of your comments. So how do we identify lower risk, high returns. So there's a couple of things that I look for. And I think I've talked about the channel. Maybe I haven't worded it in that way. But some of these the big diversified mining companies, BHP, VALE, Norilsk Nickel, NILSY, South 32, SOUHY, Vale, VALE, Rio Tinto, RIO. Those are some companies that they have diversified mining companies. They are producers. They have their hands in exploration and developing mines all over the place. They are well-established companies. Southern Copper, SCCO, Glencore, GLNCY, EXK for silver, AG, First Majestic for silver. These bigger companies, your risk goes way down in relationship to an explorer. And I know a lot of people, they want to jump into these exploration companies because the returns can be so big, but the odds are against you. A lot of these companies they're not going to develop anything in the gold and silver area. So I tend to go towards royalty companies and the bigger companies in those sectors, ones that are producing. So EXK, AG are kind of the bigger silver producers, and Mag Silver. You hear me talk about this a lot. I like those because I know they're going to move, and there's a lot less risk there in relationship to the little exploration companies. If you have a portfolio that's 100% exploration, I don't know if that's going to get you where you want to be. The diversified mining companies, those ones that I named, they are diversified by nature. They have many minerals that they extract from the ground. They could even have coal, they could have uranium, they could have oil, and they could have a bunch of copper, nickel, iron ore, whatever it may be. I like that diversity because it also manages risk. Because if one goes down, they have got other things coming in as well. And you basically have a basket of commodities that they mine going up. So I consider those to be low risk, high returning companies. But your returns may not be as big as a developer who makes it. But the developer who makes it, the odds are against you. So you have to do more research. You have to make sure you're picking the correct companies. And my approach, because the returns are so big in those type of companies, is I spread my money out. I spread my risk out amongst the high risk, super high reward companies with lower amounts. I've got smaller amounts in there. I load up on the diversified mining companies. They pay dividends, and they're going to return, I think, very well over this next big bull market. Plus, they've got launching pads for chart patterns. They're just gigantic. And when they have big, gigantic patterns like that, that's something to push off from and move higher. So a company like AG, EXK, all those ones, that's where I have more of my money allocated to than, say, a small exploration company that's more of a shot in the dark. So that's what I mean by low risk, high return commodities. I also like royalty companies quite a bit. I have a lot of money in royalty companies. And the reason I have a lot of money in royalty companies is because you get paid without doing any of the high risk activities. And they're diversified by nature. They have a bunch of different revenue streams coming in. They may have 40, 50, 60, 100 different royalties. And if one or two of them underperform, you still have 98. So they're diversified by nature. They have 100% exposure to where you want: gold, silver, copper, whatever it may be that you like. And they are lower risk, high return by nature. And the royalty companies are pretty pure in return. So they produce more, they get more from that royalty. If the price goes up, they get more with the price. So I like that area very much so. That is a lower risk, high return area, the royalty companies. So that's one of my favorite areas. And And my higher risk ones that I put a little bit less money in are those small ones. They may not be getting money now, but I'll still put some money in there and let them ride if they've got a good area of royalties on. Something like a Teuton Resources or Ely Gold. Here's a couple other ones down here. Looking for value in the comment section, guys. DXY looks like it could go higher for a few weeks. It very well could. DXY, so commodities go higher because they're priced in dollars. When the dollar falls, it provides a tailwind to our investments. The dollar falls during an expansionary phase of real estate. You've heard me say this before. So if the DXY goes up for a few weeks, we could see a pullback for a few weeks. And that's okay. That's okay. We need pullbacks. We need to flush things out. We need lower prices to buy at, right? It's about getting your mind and your paradigm wrapped around how long we have to hold these things. And usually the expansion phase of real estate lasts for about 8 to 10 years, I think, for this next one, because that's what it was down for, 2011 to 2020. So it's about 9 years. I'm just capturing it, 8 to 10 years. And we have to watch real estate, because if we do have problems there, it should show up in inventory. It should show up in prices and all that. And if it starts to decline, we may have to adjust. But I don't think that'll be the necessary case, because structurally, I think we have to build more homes in order to get out of this. Swapping ownership doesn't fix the problem. That's my opinion. We'll have to continue to monitor the data. So it says, Rick Rule just said that uranium juniors are overvalued. While not in the case of seniors, big producers, some other investors claim that the value appreciation has already baked into the cake, so to speak, for the juniors. I understand that the spot price needs to catch up to justify the stock price of the miners. What's your thought here? So for uranium and the junior companies, it depends on some of the juniors have had pretty big runs. Some of the other ones, some of them haven't really gone much of anywhere. So I'm buying what are considered, quote, the laggers. And I don't know how he's necessarily valuing these. He's probably valuing them to the current uranium price. Now, the markets are forward looking. What price should you be using to value these companies? What price of uranium? Is it $30 that it's at right now? Or is it the $60 or $70 that it's going to be in the future? So I would think that the junior and just in general, if we know the price has to go up, I would think that the uranium companies should price in a $50, $60 uranium price if that's where the price has to basically go at a minimum. Now, what if the price? I don't think the price is just going to go to $50 and stick there. I think it's going to blow past it, because investing deals with human beings, and human beings, we are very tactical, not very strategic by nature. So we kind of do things when we have to. A lot of people, not everyone, but a lot. And then we've got the emotion side of us. So what's going to happen is the price is going to start to move, and then it'll start moving even more rapidly. People are going to get scared. You're going to see greed and fear. These two things: fear in the people who need to get contracts, and greed by those on the opposite side seeing an investment opportunity and piling into maybe the Sprott Uranium Fund, taking physical off the market, and there's no physical left. So then you get in this massive squeeze, and the squeeze is going to be a fear and greed-driven squeeze. It's going to be greed from investors, and who knows how this actually ultimately plays out, because if you have a Sprott fund and you've got hedge funds and all these people buying into it, they're just going to take all the uranium off the market that does get produced. And then you've got this big delay of when mines can come on. It could be 7, 9, 10, 20 years. So you've got this massive squeeze that develops. The people and the utilities who need to set these contracts see it, and they get fearful and start jumping in trying to do contracts before the price goes higher. And now you've got the greed people buying all the physical uranium and putting it in their fund. And then you got the utilities trying to put in contracts because everybody's afraid that the price is going to go up. So you've got fear on the utility side and greed on the investor side. And you could develop this huge squeeze. You could see a massive ramp higher. I don't want to see that. I want to see a steady move. I don't want to see this big ramp up where we got to sell out and do all that. I'd like to see a nice steady move where utilities, they come in, they start doing contracts, maybe. However, I don't know the contract side in uranium as well as a lot of these other people. So I don't want to pretend like I know a ton on the contract side. What I know is more on the market side, investing, reading charts, and finding opportunities. So when you look at that, I think we could see a big price spike, even though I don't want it to happen. I think it might just happen naturally because of how humans interact with each other and their emotions. So that's why I don't know where the fair price necessarily should be. I don't know where these uranium stocks should be priced at. I mean, you could look at history. Usually what happens is the uranium price takes off and it basically just goes straight up. It doesn't really pull back very much. I mean, it literally just marches higher. And if that's the case, I'm just going to sit in it. Sit in it. I'm not worried about value in terms of what he thinks in terms of value. I know that the sector's undervalued, and I'm buying some of the laggard companies because when this takes off, I think it's just going to be like you basically go not straight up, but it's a very steady move higher. With not too many pullbacks, very large pullbacks, I should say. So there's that. When charting, do you give any value to gaps and whether those gaps are filled? Not necessarily. A lot of them do get filled. I think it's I can't remember the exact percentage. I've seen a whole bunch of different percentages and what people estimate of gaps being filled. But it's something like 60 or 80%, somewhere in that range from what I can remember. But we'll see. We'll see. I've seen a lot of gaps not get filled too, especially in very strong stocks. They'll gap and they just run. It's like, oh my goodness, this thing took off. SM Energy, if you rode that in the beginning of this channel, I put in SM Energy at $1.50 was the buy. At least that's where I bought it at. And then if you saw after it broke its downtrend, it pulled back a little bit and then it just took off. It was like 20% day, 24% day. It gapped up and never filled some of those gaps at the bottom there. And it took off. And before no time, it was up at like $4, $5, $6. And then it just kept going. It paused a little bit and then it'd go. Like boom, 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 20%, 14%, 10%. It's like, oh my goodness. And quite honestly, I haven't really seen too many stocks go up that fast. That is pretty rare. I mean, it was a big move. It was it went all the way to, I can't remember where it slowed down, maybe $16, $18, $16 from $1.50. It did a 10x very quickly. And then it went sideways and now it's starting to take off again. So yeah, I watch it, but I don't put too much on there. Says Andy, can you clarify one point? By the way, you keep cost averaging in. It sounds like your allocations are not going to be 2 to 5% per company. If this is not the case, then what is your criteria to cost average further as you get some spare change on you and you already allocated in some of these companies you talk about? It depends, because my original investments are roughly between 2 and 5%. It's not a hard rule. It's just an area to be in. I'm trying to give you guys an area and saying, it should be around here-ish, and whatever you're comfortable with. But you shouldn't be having 25% of an entire portfolio that you originally put your money into be your portfolio. As companies gain and they go higher, they're going to make up different percentages of your portfolio. SM Energy in one particular stock here, I overweighted that in the beginning. I gave it a pretty good position size of what I had in my portfolio, and now it's gigantic. My portfolio lives and dies almost by determining what SM Energy is in some of the portfolios. Because if you put a 5% on it, and now I'm up, I don't know, 16 or 17 times my money. I think that's what that is, 15 to 17 times my money. That is now a much larger percentage of my portfolio. Now, I'm not trying to hold my allocation to 2 or 5% if that money's being made and the valuations are still good. I am letting it ride. You don't want to steal from your best performers and give it to your worst performers. That's not how you want to do this. You want to let them ride, and if you get better buying positions, pile in if you want. Make it a little bit bigger. That's okay. Let your winners ride. And if you want to add to your winners, go for it. Do not starve your winners. Feed the lions. Feed them. Starve the dogs that are sitting back there not performing. Starve them. That's fine. Don't get in the habit of feeding the dogs and starving your lions. That's not what you want to do. You want to feed those lions and keep them moving forward. Keep that portfolio just crushing it. I bought into Centennial Development. I cost averaged up. I was not afraid to do that. And what happens is, I bought it when it was pretty cheap, probably around $1 or so, was one of my positions. And remember, my cost basis shifts, and that's why I don't know these off the top of my head, because I buy them in 3, 4, 5, 6 different times, and the cost basis changes based off of what you purchased. I'm not as worried about what my cost basis is. I'm not trying to have the lowest cost base ever. What I'm looking at is, what is the opportunity that this company can give me at this moment? And if the opportunity is insane, if you see an insane chart pattern, an incredible setup, and everything is still cheap, I'll hit the button again. I'll say, add a little bit in. Screw it. So Centennial Development, I was up a big amount. I bought it at like $1, $1.77. Those are 2 spots I remember. I bought it like $2, maybe $2.50, something like that. It went all the way up to like $6, I think, and then pulled back around $4, and I bought again. I bought again at that $4 at the bottom of what I perceive to be the handle of a cup and handle pattern. That cup and handle pattern is gigantic, and if it goes to the upside, I mean, guys, we can change some lives. That's what I'm saying. So I added a little bit more in there in a different portion of the portfolio. I added some more money into it. These companies, they are getting big. Some of them are 10 to 15% of my portfolio in some of them, because they've gotten so big, they've earned me so much money that they're now 15 or 20. I think it's probably about 15. I can't remember the exact percentage. I didn't really look, but it could be 15% or 20% of my portfolio in some of these companies. If you started with 5, you overweighted it, and they blew up 15x. So, and remember, you guys have to be prepared. You have to know what you're doing in order to get a 15x. Why am I still not selling that? Because I think the opportunity, if you look at the cup and handle pattern that SM Energy has, they could go way higher. And I'm not here to sell when things are still cheap. I'm just going to hold on. I'm going to hold on. Now, if it goes down a little bit, that's okay. I've got a bunch of other companies that I'm in. I'm going to continue to cost average in what I think are the best opportunities that the market has to offer. Good chart patterns that are solid. And I'm ready to go into some high risk ones with a little bit of money. Now, I piled into some of these royalty companies and diversified mining companies. And I'm holding on. They're up a lot, and I'm still holding. And the value and the chart patterns, they all look really good. So this is an amazing opportunity, and it doesn't come often. You'll probably only see it once in your life. And that's how big of a deal this is. I know it's once or twice in a lifetime. You're going to get another opportunity, but it probably won't be in commodities, and the ratios may not be this far out of whack. I mean, this is way out of whack. And some of these people, you're getting a little bit of a taste of what it feels like to be on the winning side and what it feels like to be an educated investor. And you know what? You got to learn this stuff. The money does not go to the undeserving and the uneducated and the uninformed. All the money is going to flow to those who are informed, educated, and prepared. It's as simple as that. If you're not prepared, if you're not educated, what I'm telling you guys is the opportunity's here. It's right in front of us. Get educated. Binge watch my videos, look at my playlist, subscribe to the channel. I can help you guys through this commodity bull market. We are going to see downs too. It's not going to be straight up. We are going to have to ride up and down, look at those ratios, look at real estate, make sure everything's good. Look at bonds, look at interest rates, look at all those things. Copper to gold ratio. If everything's looking good, we sit tight and hold. We have to have those massively all kind of get out of whack. And remember, I'm not like the expert of all experts on everything. I try my best. I learn this stuff. Here was another question that someone had, and I know this is getting long, but they said, are there books or anything else that I could learn from? And you know what? I pieced this all together myself. I did not read this from a book. I did not read this from anything. I pieced this all together, and what I did is I took a whole bunch of different data. And I don't need to read a book to do this. Remember, I have an engineering degree. I did lots of math, lots of physics, lots of all that stuff. So what you want to do is you take the data, you throw it into things, and then you see how they're correlated. If they have a high correlation, if they have an R squared value that's very high, or if you've got something where things correlate very well, and every time this happens next, you get your answers there by looking and solving basically a big puzzle. That's what I basically learned in school. Is you take these big data puzzles, whatever it may be, and then you start focusing your efforts on trying to solve the puzzle. What I did is I just saw that things were correlated. So I correlated things together. I said, these are leading indicators. I did lots of reading in terms of articles, searching on the internet for specific things to see how things are correlated to each other. And some things, it's pretty opaque. Like you almost have to do it yourself. Not many people have written a book on some of this stuff, like the real estate residential land values and how they cause crashes. That's kind of how I drew to the conclusion. There was no book. I'm sure there's some people that think the same thing that have found that out. I guess there was a couple of YouTube people, someone linked it to us and he said, hey, these people think the same way that you do. And I was like, yeah, they do. So they also figured it out the same. I didn't use anybody to figure this out. I just did it myself. And then I did read other articles and I just started piecing it all together. So I wish there was a really good book, but I just don't know of any that are that great. And again, I invest for the big structural moves. I don't worry about news. I don't worry about any of those short-term little movements. Most news is just a short-term movement, and you don't have to be necessarily worried about the short-term news. A lot of people worry about news, but it doesn't affect our stocks structurally. Structurally is demographics, real estate, because that affects the dollar. The long-term move of the dollar, and then the supply-demand, cost curves, like those types of things are structural. We can't have a news thing outside of maybe somewhere where we get more supply of uranium. I don't think uranium markets, you can't solve the uranium market by not increasing the supply of it. It's not like, oh, this guy found some uranium on the side of the road. It just ruin the entire market. So you could have news where the dollar goes up, uranium pulls back, and you're like, well, that's a buying opportunity. That's news. It's not a structural change in the markets. So hopefully you guys like this content. I'm trying to get you guys answers on this on the subscriber questions. Leave comments, ask whatever you need to do. I can do videos on it. Thanks for listening. This is Finding Value.